Welcome to Breaking Bread presents Fibbing Part 2. In this video, I want to break down the fib levels just a little further and show you how you can use them to stay in your day trades longer and not let this market shake you out of your plays. Quick disclaimer before we begin, this video is for training purposes only. I am not a financial advisor. I am just sharing with you the tools and ideas that I use when I swing and day trade. So you assume all risk when using those ideas and tools that I am sharing with you when you place your trades. All right, so fibs, what are we going to talk about in this video? I'm going to do a quick refresher. I'm going to talk about trending, area of confluences, how to stay in your trades longer, and then I'm going to take it to the charts and show you some examples. So let's start with a quick refresher of some of the key things that I spoke about in the first video. And one of those key things were the levels. I spoke about the 23.6, which is your shallow pullback, your 38.2, your 50%, and your 61.8. Those two are your golden zones. I also spoke about the 78.6, which I consider my last line of defense because this is the lowest I'm letting price go before I consider this play a reversal. Now, in knowing this, you would definitely see the market do a deep pullback to this level, knowing most will cut this play and it's going to take out stop losses along the way, only for price to pop up and head back in its original direction. So for this 78.6 level, I would use this for mostly entries. I also spoke about finding you an indicator or marking it yourself of the 50% of the higher time frames. So I told you to go on your previous year, previous quarter, previous month, previous week, and your previous day and find your 50% level. Since we know price is attracted to the 50% level, it only makes sense for us to go to our higher time frame, which is telling us the clearer picture of what price is saying, and mark those 50% levels. Once we see price retrace back to those levels, start heading in those directions of the 50% levels, we want to see what price is going to do. Is price going to reject? Is price going to bounce? Or is it just going to break through the level? But that's why you want to mark it, so you can possibly find a setup when price approaches those 50% levels. Also showed you how to connect your fibs. So here we're going to connect the clear uptrend fib. So you see prices in a clear uptrend. So we're going to connect from the lowest low, meaning the bottom of the wick of this candle before the move started making its way up, to the highest high, which is the top of the wick of this candle before the pullback began. So that's the swing low to the swing high, and we're watching what price does here to the right. It's the opposite for a downtrend. We want to go to the highest high, which is the top of the wick of this candle before the move down, and we're going to connect it to the lowest low, which is the bottom of the wick of this candle, and see what price does to the right. So swing high before the move down to the lowest low before price began to pull back. So what time frame? The time frame depends on what you were trying to do. Are you swinging or are you day trading? Now for me, when I'm looking for a setup, I will fully analyze the play starting at the year and working my way down. So I'll go on my year time frame. I'll place a fib on my year time frame of the trend, and I want to see what price is doing. Is it bouncing or rejecting off my fib levels? Are we in an uptrend or downtrend? Then I move down to the quarter. I do the same thing. I'll place my fibs on the trend on the quarter, see what price is telling me. And I'll do that down on the month, the week, and the day, and sometimes the 4 hour, just to get that full picture. So for you, if you're day trading, I would start from the day chart and work my way down to the 15 minutes and place a fib on a time frame. If you're looking for a longer position, then I would do the week chart and then pick one of the smaller time frames and see what price is telling you. Now, for the purpose of this video, I'm going to focus on day trades. So I will be using a day chart down. All right, so let's get started. Let's talk about take a moment to click that like and subscribe button below to stay up to date with any content that I release. No pressure. All right, so let's get started. Let's talk about trending. So you want to be mindful of the overall direction of price of the overall trend. So this is important because let's say if you're something like SPY. SPY is in a clear downtrend, but you want to take calls, which means that price could possibly react at one of those key fib levels that we spoke about earlier. Now, it definitely can keep pushing and turn into a true reversal, but you just want to keep in mind that this may just be a retracement for price to head back in its original direction. So what you want to do is you want to go look at that day chart. You want to see what the trend is on the day chart. And you want to ask yourself, if I enter this trade now, is this trade a continuation of what the day chart is telling me? Or am I possibly entering on a retracement for price to head back to those fib levels and reject and head back in its original trend? So these are things you want to ask yourself and you want to check out before you enter your trades. Here you see prices in a clear downtrend. Right, so we're in a clear downtrend. So we're going to connect from the high of this wick to the low of this wick and watch what price does to the right. Now, if you're taking this for calls, you definitely can, but just be mindful that price can reject at these fib levels, which it did here at the 38.2, and it began to pull back. Same thing here. You could have took this for calls. And what did it do? It got all the way back to the 78.6. And what did I tell you guys earlier? The market will do. It's pull price all the way back to the 78.6. Scare people out of their plays, especially if you were in this for puts. You definitely would have closed out your play here, or before it got here. But this definitely would have scared you out of your play, only for price to head back in its original direction. So when you're looking for plays that are going against the trend, just keep in mind this is possibly just a retracement to head back in its original direction. Now, it is possible for you to take this for calls and then it just break through and now we're going to go create a new high. It's definitely possible, but just keep in mind that it's also possible for it not to do that and it could just reject your fib levels. In this example here, we have a clear uptrend. So we connect from the lowest low before the uptrend began, which is the bottom of this wick, to the highest high before the pullback began. And we watch what price does to the right. Now again, you can take this play for puts. Just know you are going against the trend. And price can reject at one of those previous stated fib levels. As you can see here, it got to the 23.6 and it bounced off of it twice before it broke through. Got to the 38.2, did the same thing. It pushed past, but then it started to pull back above. So it bounced off that level. So you just want to be mindful when you're going against the trend that is a possibility for that play to bounce off of one of those fib levels and head back in the original direction. Also look here to the right. This is my indicator for the previous day 50%, previous week 50%, and the previous month 50%. So as you can see, price is attracted to the 50% level because what did it do? It got to this previous day 50%. It went all the way above it only for it to pull back down and close below it. This is why I say you should mark those higher time frame 50% because this definitely could have been an entry for puts once price got back below this 50% of the previous day. So make sure you're marking those levels that I said, the year, the quarter, the month, the week, and the day. Find those 50% levels. All right, so areas of confluence. So this is when different indicators or tools converge or overlap in a particular section on the chart, and it creates an area of confluence. Now, this confluence suggests that multiple factors are coming together at that point, potentially increasing the significance and reliability of the trading signal. Now, these areas are interpreted as strong levels. So what that means is you want your fib levels to line up with whatever you use to read price action. So this can be Broadening formations. With me, I'm a stratter, so I use Broadening formations. If you use VWAP, use VWAP. If you use EMAs, use EMAs. Use support and resistance, you also can use that. But you want it to align with what your fib levels are, and then you want to execute. Here in this example, here are my fib levels. Area of confluence would be here. Purple line is my broadening formation. It's aligned with my 38.2 level. As you can see, price pushed all the way down here before it started heading back up. So it bounced off my broadening formation and the 38.2. So this is an area of confluence. Now you can find these areas of confluences on any time frames, just like fibs work on any time frames. The area of confluences also works on any time frame. It can be found on any time frame, but it's still the higher the time frame, the stronger the level. All right, here you see QQQ's 4-hour clear downtrend. Area confluence in this image would be this 78.6. It's aligned with my Brownian formation. So you see price pushed above, got to this highest point, it rejected off my Brownian formation, and it rejected off the 78.6, and it closed below it. So this is the area of confluence. Same thing here. Purple line, Brownian formation, aligned with my 50%. This is an area of confluence. Right? So if you use VWAP, this is where you want your VWAP to be, or your EMA, so your support and resistance, your supply and demand. Whatever you use, that's what you want to see aligned with your FIB levels. All right, so now that you see the confluence, what do you do with it? So this depends on what you're trying to do. But when you see confluence, you want to either enter the trade. You can exit the trade if you see confluence that's not in favor of the trade that you're in. Or if you're already in the trade, you can look to add contracts at those areas. So the same examples I showed you earlier. Told you this was an area of confluence, purple line, Brownian formation, line with my 38.2. So if I wasn't already in this play, I would look for entry here. If I was already in this play, then this is where I would look for contracts. And something else that adds to my confluence is the full time frame continuity. What's full time frame continuity? That's when your time frames are all going in the same direction. So here in this example, I have my day, my week, and my month going up. So this adds to my confluence that I already see here. And if I didn't say it already, my blue outline candles are my uptrend candles. My white outline candles are my puts downtrend candles. So when I see that I have full time frame continuity, that adds to my confluence that I already see here with my Brownian formation and my 38.2, then I would trust this call for this trade, trust this play for calls. Now let's say for whatever reason you're in this play for puts. This is where you would use this on your chart as an exit out of those puts, because you have an area of confluence that's saying this is going to head back to the upside. So this is probably where you would want to exit, or even maybe just take some profits and just see. But this is how you can use confluence that's going against the trade that you're already in. All right, so again, here, 78.6 aligned with the Brownian formation. If I wasn't already in this play, then this is where I would look for entries. If I was in this play for calls, I may exit right here. Same thing here. With the Brownian formation aligned with the 50%, you can look for an entry here. If you was in this play for calls and you made it through this one, you decided to hold, well, this confluence here adds to your call side. So this is where you want to add contracts, or this is where you want to trust that you can stay in this play just a little longer, and you definitely can. Now, I know you're probably looking at this and was saying, okay, well, why would I want to enter here? It only went there. But how would you know that? So the only way to know is for you to get in the play. So I'd rather be in the play and find out than to be on the sidelines and be mad that I didn't take the play. So all you can do is find an area of confluence and execute. How far the market want to take you and how much profit they want to give you, that's up to the market. All we can do is get in the play. All right, so how to stay in longer? You're going to connect the fib on the first candle after it closes. So based off whatever strategy you use and whatever time frame you're playing on. So if you play on the hour, after the market opens, that first hour candle closes, you want to put a fib on that candle. If you play on the 30 minutes, after the first 30 minutes after market opens, you want to place a fib on that candle. And it's the same thing. If it's an uptrend, the price is in an uptrend, then you're going to connect from the low to the high. If price is in a downtrend, you're going to connect from the high to the low. If you play off the 1 minute, you would do the same thing. After that 1 minute closes, if it's an uptrend, you connect from the low to the high. If it's a downtrend, you can exit from the high to the low. And remember, the higher the time frame, the stronger the FIB levels. All right, so here you see the 1 hour and the 30 minute. So you have a 1 hour and a 30 minute. After this first 1 hour closes, I place a fib on this candle. So this is a clear uptrend. So I'm going to go from the low to the high. And I'm going to watch what price does to the right. 30-minute example here. Same thing, uptrend. I'm going to go from the low to the high and watch what price does to the right. Now, if you're already in this play, you see prices respecting your 38.2, so there's no reason for you to get out of this play. For me, when I'm day trading, I close out my plays and price close below the 38.2, and sometimes the 50%, I'll let it get there, but it has to close below the level, not push. As you can see here with this candle, it pushed below the 38.2, but it did not close below the 38.2. And that's what the market does to play on our fears. It will push past the level and then it starts to pull back. So when knowing that, price has to close below that 38.2 and sometimes the 50% for me to want to get out of this play. And if price never closes below that level, then I am never getting out of this play, especially if I have time on my contracts. I'm not getting out of this. It never closed below the 50%. Also, something I'll recommend you guys doing is going on that previous day 50%, the previous day candle, and placing a fib on that candle. If price is staying above the previous day 50%, then that's a high probability for that to be a calls play. If price is staying below the 50% of the previous day, then that's a high probability for puts. So before the market even opens, go ahead on that previous day and throw your fibs on there and see if we're below that 50 or are we above it, until that first candle closes, and then you attach the fib on that first candle after it closes. So here I want to go over an example of a play that I took, being patient, because I missed my entry at open, so I had to wait for a pullback. So I placed my fib on this first candle, and I watched what price did, and I waited for a pullback. So price clearly pulled back to my purple line, brought in formation, and it bounced off of it. Next candle did the same thing, got back to the 61.8 in my broad information, it bounced right off of it. So based off my strategy, I'm going to look for entry when price breaks the high of this candle. I already have an area of confluence, gave it to me twice. So once price broke the high of this candle, this is where I took entry, and I played it to my broad information up here. This was a Friday, and these are 0-day contracts. So a pullback is not something I'm staying in on a Friday, especially not on a video. Now I was in the money, and I could have let this ride, but I don't trust the market, so I take what it gives me. So I played it to my broad information. Price began to pull back, so I took my profits. Now this one, same play, just a different type of influence. I don't have any broad informations here. I don't have no VWAPs, no support and resistance, no supply and demand. I don't have that here. But what I did have at the time, I had market sentiment to the upside, meaning that your indices such as SPY and QQQ were all to the upside. All right, so that adds to confluence. The video was already in the uptrend. That adds to confluence. I had already previously taken this play that I showed you guys in the previous slide for calls. That adds to my confluence. And I have this gray area here, which is a gap. And that's my favorite type of play. So once I saw price go into this gap and come out and get gas, I knew that I would look for entry on this play. Now, if you want to know how I play gaps and why I love them so much, go check out my 2 gap videos to where I break this down. But once I had all that in my confluence and I saw price started to pull back, I was like, all right, cool. This is where I'm going to look for entry. So I placed my fib at the bottom of this candle to the top of this candle, and I wanted to see what this pullback presented. Now, I definitely could have got this whole trend and placed my fib from the bottom of this to the top of that first high candle that I just showed you guys. I definitely could have did that. But use the fibs how you want to use the fibs. So in this situation right here, I just wanted to measure the pullback that was currently happening. So I placed it at the low of this candle to the high of this candle. And once I saw price push past the 61.8 and slowly start pulling back up, then all right, I'm trusting this to the upside. So once price broke above this high, based off my trading strategy, that's how I got into this play. I wrote it to this 23.6. What is this 23.6 level? Where did this come from? Again, go watch my gap video and I go over this. But for gaps, I like to place fib on those because it's far too many times I've seen price get into a gap and it reject the 50% area of that gap. So I like to place fibs on my gap areas. So this 23.6, that's where this comes from. So once price got to this 23.6 and started pulling back, I took profits at 130%. I definitely could have held this longer, but again, I was on a 0-day contract and I definitely was not in the money at the time. So I took profits. Also, this is sticking out to me for some reason, so I'm gonna talk about it. The quarter 50 is aligned with my broadening formation. What is this? An area of confluence. Definitely could have took this for puts at the end of the day to catch this sell-off. So when you're trading, you just want to try to slow down this market. You want to have clear eyes and a clear mind for you to slowly see what the market is telling you. Once you are able to do that, like this is easy money. You just got to be patient, wait for it to set up and execute. Like you saw in the previous image here, I had missed my exit, but that don't mean that the play is dead. The market is going to present multiple opportunities throughout the day for you to make some money. All I did was wait for this pullback. I got my areas of confluence aligned and I executed. That's all I can do. You don't have to jump in at open. And like I always say, sometimes that second move pay more than the first move. And it definitely did here. First move on this got us to a high here. I price pulled back, got a better entry, and I executed, and I took it to my broadening formation. Sometimes patience will pay off. You just got to be patient. All right, so let's take it to the charts. Let's go over some examples real quick. Now, like I always say, I am a think and swim person. So I'm going to show it to you on think and swim. If you're not a think and swim person, I am sorry to hear that. But just take what I'm saying and apply it to the platform that you're trading on. So here we have Dollar Tree. Let's pull it up. And again, the blue outside candles are my uptrend candles. My white outline candles are my downtrend candles. So let's look at it on a day chart and see what the trend is. So we're clearly in the uptrend, right? This was the previous high. We already took off that high, so we're previously or currently in the uptrend. So I'm gonna place my fib on this, see what price is doing. It's sitting at that 23.6. All right, cool. So this might continue back down, or it could possibly pop back up tomorrow. We shall see, but we're clearly in the uptrend. All right, so I want to talk about this day in particular. This day in particular. But I'm going to put my fib on this previous day. Like I tell you guys, put it on the previous day until that first candle closed after the opening of the bill. We're going to go down to, let's go down to the 5 minute. Just in case we got some 5 minute players in here. All right, so like I said, if price is above the previous day 50, that's leaning more so towards calls. If it's below it, it's leaning towards puts. So we're above it. Here, right here, I said after that first candle closes on whatever time frame you're trading on, you want to place a fib on that. So it's the 5 minute time frame. So this is the uptrend. Price is going up. So I'm gonna place a fib on this. Boom. Now, like I said, for me, when I'm day trading, if price closes below the 38.2 and sometimes the 50%, I'm going to exit. But since this is a small time frame, I need to go up a time frame just to confirm if what I'm seeing, am I really seeing that? Because a reversal on the smaller time frame could possibly just be a pullback on the higher time frame. So we're going to go up a time frame and see what we're looking at. So let's go to the 15 minute. Cool, we get to the 15 minute. So these two candles is what you saw down there on the 5 minute. And as you can see, price never closed below the 38.2. Now it did on this candle, but we were still in that play at that time. We were on this candle. So on this candle, it never closed below the 38.2. It pushed past, but what did it do? It started pulling back up. And what do you see here? My purple line. This is a broadening formation. So this is an area of confluence to trust this play back to the upside. Now, if you were already in this play and you came back up to the 15 minutes, then you would probably stay in this play and not let this market shake you out because it pushed past. Remember what I said? I don't want it to push past. I want it to close. If it never closed, then I'm never getting out. They can't scare me out these plays no more. Not with these fibs. So it pushed past, but it started pulling back up. It got back above my broadening formation, so I'm trusting this play to the upside. So let's say you were already in this play, and price starts to pull back here. You can either leave it on that first candle that closes, or you can measure this whole uptrend here and see what price does. Price never got back below the 50% of this move here. So there's no reason for you to close out of this trade. There's no reason for you to. It never got not even close to this 50%. Even when it started pulling back right here. Let's adjust it and see. Oh, wrong one. Where did it get to? The 23.6. It never got back to the 50%. So this is how a day trade is going to turn into an overnight hold. Price never got back below this 50%. Everything is saying, pointing to the upside. So why get out of this play? So let's say you stay in this play. Market open, it gapped up. Great, even better. So as you can see, it gapped up and it started moving up. Now you can leave it down here or you can adjust it to where the candle that you entered off of, to where the pullback began on that day. And as you can see, all price did was stay above that 23.6 area. It never got back down to this 50% area. So again, why would you get out of this play if price is not getting back below or closing below the levels we say we're going to exit at? If your plan is to exit at the 38.6 and price has to close below the 38.2, then that's what we're going to do. If price never does that, why get out of the play? Now, if you're going to be holding these overnight, you do want to make sure you're securing some profits, because I'm sure we've all been in plays to where something was strong in our favor today, and then that next day market opens, it gaps down, or it's not in our favor anymore. So to make sure you're securing profits along the way. But if nothing is telling you to get out of the play, then don't get out of the play. And even with this day, let's say you didn't even get in here on this day. So we're going to throw our fib on this day. Because like I said, throw the fib on the previous day to get the 50% of the previous day. That's the high. So this is the previous day 50%. Price is definitely above that. So we're leaning towards call still. So based off this first candle, after this 15-minute closes, let's say we took entry based off our strategy. After this 15-minute closes, we're going to throw our fib on there. Right, so price pushed back down to that 38.2, didn't quite touch it, and then it started pulling back up. But it never closed below the 38.2 nor the 50%. It never did. Now, we have some major deep pullbacks here. So we can adjust our fibs if we want to, or we can just leave it on that candle since we already see prices not touching that 50%, but you can definitely adjust it. And then when you adjust it, it closed below these 50%. So are you getting out if you had just got in? Are you sticking to your rules? If price closed below the 38.2, are we getting out? Are you sticking to your rules? So you just got to make sure you're sticking to your rules. Even right here, for this first pullback, price got to the 38.2, but it didn't close below it. So you can hold this play. And what it do, it made a new high. So it wasn't until here to where price closed below your 38.2. But if your rule is to get out when price closed below your 50%, it never did that. But you just want to make sure that you're taking profits along the way, just in case you have something already stored up, just in case news come out, or or the next day it opens and it's against you. You've already secured some profits, so there's no reasons to worry about it. But that's how you would do it. All right, so let's talk about patience. This is so key. And I want to say this is probably the hardest thing that I've had to deal with in trading is having patience. But this is a discipline that I'm building every day. But patience is so key and it's so important, especially when using fibs. So you want to let price do what it's going to do, find those high areas of confluences, and then you're going to execute on the play. Having patience will also keep you in your plays longer because you're not going to let this market shake you out of your plays. Remember, price has to close below the level, not push, close. There's be many times where you see price push past your exit level, and what does it do? It head backs into your favor. So you have to have that patience to be like, nope, I'm not getting out. I said close, not push. So don't let this market play on your fear. So far too often, it will push past your level, taking out all your stop losses and try to scare you out. But we're not going to allow that. It needs to close below our level. And like I said, if you play on the 5 minute before you exit that trade, go on that 15 minute, see what price is telling you. If you're on the 15 minute, go up to that 30 minute, go see what that is telling you before you exit that trade. If you play on the 30 minute, go up to that hour, see what that hour is telling you. Just have the patience, slow the market down. Just being patient, letting price retrace, finding that A plus setup, them high probability setups, and execute. That's all we can do, but we got to be patient. There's no reason for us all to hop in at the market open. You don't have to always do that, especially if you miss your entry. Just wait. Throw that fib on there like I showed you in the video play. Let it set up and then execute. It's always plays in the market. The market always presents opportunities for you to find a play. So there's no reason to have FOMO and think you're missing out on anything, because you're not. You just got to be patient and wait for that next setup to set up. And then you execute. All right, so some quick tips before I end. It's important where you connect your fibs at. So like I told you guys, for an uptrend, you're going to go swing low, swing high. Downtrend, you're going to swing high to swing low. It's important to know your levels, your 38.2s, your 50%, your 61.8, and then that 78.6 is your last line of defense. And you want to know what trend is the stock in. So you want to know the overall trend on the higher time frames. Are we in a downtrend or are we in an uptrend? If you're entering this play, am I entering into for it to continue the overall trend, or I'm entering on a possible retracement, which is going against the flow of the overall higher time frames? And you want to throw your fibs on after the first candle closes on whatever time frame you're planning on. So we don't predict, we react to what price is telling us, and we're looking for high areas of confluence, right? So we're looking for our signal candles, we're looking for price pulling away from our fib levels. When our fib levels line up with whatever we use to read price action, and of course if time frame continuity is in our favor, these are things that we use for confirmation to execute on our plays. But once that first candle closes, whatever time frame you're playing on, the hour, the 15 minutes, the 5 minutes, whatever it is, you're going to throw a fib on that first candle, and you're going to look for those areas of confluences. When you see those together, execute. Then you want to make sure you have a full plan in place. So before you get into a play, you should know your entries, all your targets, your exit target, and then at exit if this play goes against you. So for me, like I said, if price closes below that 38.2, I'm out. If price closes below that 50%, I'm out. But these are all things that you want to have in place before you're even taking any plays, regardless if it's a day trade or a swing trade. Even if you're scalping, you should still have a full plan in place before you get into a play. And last but not least is being patient. Patience is key, especially with the fibs. Let that play set up, spot your areas of confluence, and execute. Simple. Sounds so simple, but it's probably the hardest thing for me when I first started. But just being patient will pay off so much. It will save you a lot of heartache just waiting for the play to set up. We have come to the end of this video. I hope this information in this video will assist you in some ways along your trading journey. I need us all to win, and I know we will as long as we don't stop. Like I always say, it's either going to work or it's going to work. That is the only option. If you have any questions, feel free to DM me or drop it in the comment section below. But until next time, you guys stay blessed. And thank you for breaking bread with me.